My name is Dr. Rush, and this is relative valuation. Relative valuation is based on the assumption that market multiples will remain constant over time. Changing market conditions such as growth expectations and risk aversion challenges this assumption. The market is forward-looking, and our market multiples work best when we incorporate forward-looking estimates. This brings us to some terminology used in industry. Companies may use fiscal years that do not align with the calendar year. We normalize these differences by referencing the current fiscal year and current fiscal quarter as FY0 and FQ0 respectively. The most recent reported fiscal year and fiscal quarter are FY-1 and FQ-1. The next complete fiscal year is FY1. To compare annual metrics from companies with different fiscal years, we use trailing 12 months and next 12 months. The last 12 months includes the last 4 reported quarters. The next 12-month estimate includes the current quarter and the next 3 fiscal quarters. Managers do not use these relative terms for quarters. They will report past performance and future expectations within the context of their own fiscal year. The most common market multiple is the price-to-earnings ratio. The PE ratio is defined as the current price divided by 4 quarters of earnings per share. The PE ratio is sensitive to expected growth in earnings. This may come from expanding market share, widening margins, or share repurchases. Traders are often overly optimistic about growth assumptions, which means that firms with high market multiples contain valuation risk. A company may perform as expected, but the market multiple may decline for other reasons, leading to less than stellar stock performance. Ideally, we would like to have a time series of PE ratios using the next 12-month EPS estimate. The forward-looking market multiple often has less variation than the trailing 12-month multiple. Often we do not have this data, so we must adapt our methodology to apply the trailing 12-month multiple. Take the current price divided by the trailing 12 months earnings per share. Multiply this ratio by the next 12-month EPS estimate to find the price in 1 year. Discount this estimated price back to the present to find the current value. Use the equity required rate of return when discounting back to the present. The price-to-sales ratio is sensitive to profit margins. A business model with wide margins is expected to have a high price-to-sales ratio, while a low-margin business would have a low price-to-sales multiple. The valuation process follows what I discussed earlier with the PE ratio. Rather than use EPS, we use sales per share. The price-to-book ratio utilizes data from the balance sheet rather than the income statement. The book value per share is shareholders' equity divided by shares outstanding. We do not add book values over the past 4 quarters. Many equity analysts do not publish estimates of the book value per share. We can use accounting identities to produce our own estimate. The book value of a firm increases with retained earnings. Start with the most recently reported book value, add the next 4 quarters of earnings, and subtract the next 4 quarters of dividends. The rest of the valuation process is the same. The price-to-cash flow ratio methodology mostly follows that of the PE ratio. Some firms are more accurately priced using the free cash flow per share. Others are more accurately priced using cash flow from operations per share. Enterprise value is equity market cap plus the market value of debt minus cash. EBITDA may be calculated from the income statement if it is not explicitly provided. Multiply EV to trailing 12-month EBITDA by the next 12 months EBITDA, subtract debt, and add cash. Divide by shares outstanding and discount back to the present. Each of these methods provides an estimate of the current price. Drop any negative values and take the average. You may also drop market multiples where the denominator is near zero, making the ratio approach infinity.